David Madden is an analyst at the trading firm CMC Markets in London. Good to have you back with us, David. Now, as I mentioned, oil is the latest casualty from fears over the coronavirus outbreak. It is recovering somewhat now, but can you tell us why oil is being hit so hard?
Well, oil has had a pretty rough ride in the last few months. If you take a look at the price action only about a month ago or 6 weeks ago, there was a major surge to the upside on the back of the US-Iranian tensions. Then when it became apparent that the US and the Iranian regime were not going to go to war, we saw a fairly sharp turnaround in the oil price. So the market was already in decline then. Then we heard updates from the likes of China, the largest importer of oil in the world, who stated that their annual growth in 2019 was over 6%, but it was the slowest in 29 years. So it became very clear to the markets that China is cooling off. And then unfortunately, with the coronavirus crisis really taking hold, traders in the last couple of weeks became very bearish on oil, aggressive sellers of oil, for fear that the health crisis that China is enduring would actually have quite a negative impact on demand and industrial production and manufacturing in China. It was only yesterday we saw WTI, West Texas Intermediate, a benchmark in the oil market, drop below $50 a barrel, the lowest level in over a year. But as you mentioned in your update, OPEC and some of its allies are contemplating an aggressive cut to production. So we have seen a bit of a rebound, but overall the sentiment has been quite weak, and it's probably going to remain quite weak as well, because many of the industrial provinces in China remain on extended holidays as a way of tackling the health crisis.
And just quickly now, let's look at Tesla, David. Really, a lot of people doubted that it could go above $400 a share. Now it's in the $800 to $900 range. What's happening there?
This was all really sparked. The particular aggressive move to the upside in the share price was all sparked last week when the company had very impressive quarterly figures. It was the financial fourth quarter figures, earnings per share, a very popular metric for measuring profitability. That came in well above expectations. It was over 24% above expectations. Revenue was about 5% above expectations. And on top of that, the company then stated that its full-year production guidance for the year ahead of us is going to be at least 500,000 vehicles, which, should they achieve that, that would be somewhere in the region of an increase of about 35% in terms of production on 2019's years. So in terms of the outlook, it was a very impressive update. And ever since then, Tesla's share price has been driving higher, pardon the pun.
Okay. David Madden in London, always a pleasure. Thank you.